Shall we start now?
Yeah, sure. Yes.
Good morning, everyone. It gives me immense pleasure to introduce today's speaker, Mr. Vikas Goel. Mr. Vikas is a registered valuer with Insolvency and Bankruptcy Board of India under SFA category. He's a fellow CA, CFA India, and MS Finance. He also holds an MBA and is an alumni Indian IIM Calcutta. Vikas has extensive experience of close to 15 years spanning across industry and consulting. After a long stint with MNCs like PwC and EY, he currently heads Omnifin Valuation Services and has authored 2 books on valuation that are well read. He works with startups and global conglomerates in their valuation pursuit and has hundreds of valuations to his credit. Before we start, Mr. Vikas, it's my request to share with all of us about the books you have authored so that other fellow members can buy and get benefited out of your great work. Over to you, Mr. Vikas.
Thank you so much, Shilpa. So, so the 2 books, they're both on Amazon. So if you search from Vikas Goel, you would find the book. So there's one book, which is Valuation, Handbook on Valuation of Securities and Financial Assets. That is useful for people who are pursuing the Registered Valuer program. So I'm sure most of the participants here are already registered valuers. So there's another book which is called A Practitioner's Guide to Business Valuation. So I think that could be relevant for some of you. But yes, again, I mean, it's just a reference book. So,
What kind of, is it beginner level, medium or expert level?
It's medium level, yes. So it is a practitioner's guide. So you would find a lot of practical examples there for business valuation, specifically with respect to Indian companies. So we've taken some examples from Indian companies there.
Interesting.
So I think today we wanted to talk about the practical aspects of brand valuation.
1 minute, Vikas. Yes. Sorry to interrupt. Friends, it was my personal request for today's speaker to help us guide in our pursuit towards actual, Excel calculations while doing brand, because we had a couple of sessions for more theoretical, but now Mr. Vikas' pursuit will be to share via Excel, but then because of, the confidentiality matters and the numbers are close to the actual work being done by Vikas, we will not be able to share any presentation for today's session, and we will not be able to share any Excel for today's presentation. Even the recording will not be shared. Please keep this in mind and pay all your attention to, to the speaker's words. Yeah, Mr. Vikas, sorry for interrupting.
No, please. Thank you so much. Thank you. So good morning to all of you. It's a pleasure coming here again. And of course, I'm a part of BVA, so it's always a pleasure to talk to fellow professionals. While I'll be sharing some of the work that we've done around brand valuation, of course, please feel free to interact, ask questions whenever you have. And even if you have your own inputs, please do share, because the intent is to learn. That's why we are organizing these Saturday morning sessions. So I also intend to take back a lot of learning from your experiences today. I will share an Excel. I will share my screen, where primarily we'll talk through an Excel file. I'm sure most of you are familiar with the concepts of brand valuation, how the brand valuation and all works. But we've done some practical work around brand valuation. So we'll talk about that. I think first of all, whenever we look at a brand valuation, I'm sure most of you understand the difference between valuation of goodwill and valuation of brand. So there still appears to be some confusion around whether we are valuing goodwill or whether we are valuing brand. So there are under. So a goodwill valuation will happen only when we are doing a merger or an acquisition. Brand valuation can be done for a variety of purposes. So one of the purposes of brand valuation would be when the company plans to come up with a franchising agreement, right? So if I run a company and I want to allow other people to use my brand, I would give them a franchising agreement, right? So I would become a franchisor and they would become a franchisee. And by understanding what is the value of my brand, I might be able to identify the upfront payment that I will receive for them to use my brand, and also the royalty rates that we would take from them. So that's one of the reasons why we usually look at brand valuation. The second is when we want to sell the brand or buy the brand. Now, how can you sell or buy a brand? again, so we've seen a lot of brand transactions happening primarily in the FMCG segment or consumer durable segment. So for example, this I make some sort of hair oil, right? And I am a part of, let's say, Dabur. So I want to sell my hair oil business to somebody else. Now the other person, the other company which wants to buy my hair oil business would have two options. They would buy my hair oil business along with the manufacturing facilities, or they would just take over the name, right? They might say, hey, we have our own hair oil business, so we don't want to use the hair oil business, we don't want to use your manufacturing facility, but we just want to use your name, right? So in either of the two situations, a valuation of the brand may be interesting. In most cases, for businesses like FMCG, the brand valuation and the business valuation of that hair oil business, right, would by and large be the same. So there wouldn't be too much of differences. And the third common reason why we look at brand valuation is when we are looking at business combinations. Anyone wants to share, how would you look at business? Why would you do a brand valuation when you are looking at a business combination and M&A transaction?
Is it purchase price allocation? Because of that?
Exactly. Thank you so much, right? Company is buying, selling another company. So let's say there's a business combination that is happening under Ind AS 103. So a company buys another company. So let's say normally what happens is, let's say I'm the purchase consideration that we have paid, right, is, let's say, 20,000, whereas the book value of the assets, is, let's say, 10,000. So what we really need to do is we have to allocate the purchase consideration amongst all the assets that we have acquired. So what we will need to do is we will have to identify the fair value of the assets in the books of the target company. Let's say this fair value comes at somewhere around 12,000. Okay, then we have to see if there is any brand or an intangible that could have been recorded with the target company but cannot be recorded because of accounting considerations. So let's say we will say that we will identify target company's brand. Okay, or we can also look at target company's other intangibles. What are these? Example, it could be customer contracts, it could be R&D facilities, right? It could even be a target company's other liabilities, right? Contingent liability, etc. So liability, of course, would be a deduction. So let's say all of this comes at total, or sum of all of these comes at, let's say 8,000, 7,000. Okay. So now whatever is remaining, that will be the goodwill amount. So goodwill amount would be 20,000, which is the total purchase consideration minus the fair value of the assets as well as the other intangible assets that we've arrived at. So that is how we look at goodwill. So whenever a business combination happens and there's a purchase consideration which is given over and above the book value of the assets, or even the fair value of the assets for that matter, we might have to value the brand. So now there are different ways in which we can value brands. I'm sure most of you have heard some of the methods. So we have a relief from royalty method. We have got market transactions, comparables, and so on and so forth. So I'll start with the easiest, right? I'll start with the cost approach. Now, we understand that in our accounting regulations, so by the way, any question at this point? Please feel free to have any questions at any point in time, right? I want to repeat this. It's early morning. I'm sure many of you might have just got up. So let's keep this interactive. So when we look at the cost approach, right?
Actually, I have one query.
Yes, please go ahead, ma'am.
These days, I'm getting an inquiry with respect to a family settlement. The family owns the brand. I've got many products. So I got an inquiry that family settlement is happening, and say that whatever brands are there, the child brands will be given to each one person. So it's not a business as such wherein a buyer and seller are different. It's within the same family group. So this also you can keep in mind and tell us how exactly it is different from a normal market transaction.
No, it wouldn't be. So good that you brought it up, right? So let's look at it this way. Even if it's a family settlement, right? And we are sharing the brand. So let's talk about Reliance, for example. We know long time ago we had this Reliance brand which was split between Mukesh Ambani and Anil Ambani, right? But both of them retained that brand Reliance. Now, Of course, you would value that brand reliance, but then at the core of it, from a technical standpoint, there were different companies that were being formed, and these companies would have the right to use the brand, bro. Correct? So we would, even if it's a family settlement, the background of the transaction could be anything, but technically speaking, there's going to be either a business combination, there's going to be a company which is taking it over, or there's going to be buying and selling of brand, right? And for a family settlement, precisely it's going to be buying, selling the brand. So you would say that, hey, ultimately this brand resided in this company, right? So somebody has to have a, so we'll talk about trademarks a little bit there, but ultimately the acquiring companies are going to use that brand value and they will record it in their books, right? So it's still buying, selling the brand technically, right? The background of that technical transaction could be anything. It could be family settlement, it could be selling the brand as it is, right? So does that answer your question? Yeah. So it's still going
Yeah,
to be buying, selling the brand, even if it's family settlement. And that's
yeah.
one of the common reasons why you would have a transaction within the.
I have one question.
Yes, sir.
What happened? I'm from Mumbai. Now there is a retail brand. I mean, there is only one shop. I am not naming it. Very famous.
That's all
Now
right.
they have a trademark, three trademarks. Now, way back in 2016, the business was sold to a big entity with the trademarks. But
Mhm,
the family which owned, they told that we are selling the trademarks but not our brand. The
mhm.
trademarks which were sold and taken by the new entity, they are still not registered. But the brand name remains with the previous owners. Can previous owner sell that brand or monetize that brand?
Yeah, yeah. So if there is a legal agreement which differentiates between, so see, technically trademark and a brand would be different, right? So trademark is just a logo which is practically registered with the trademark authorities, right? So I think trademark value is usually much lower than a brand value. And so let's look at it this way. Um, Tata has a trademark, right? We see the way a Tata logo is created. Now, there are multiple Tata companies which are using the trademark, that logo. Okay. Now, Tata as a brand resembles with Tata as a trademark, but then the brand and the trademark are different. Number one. Number two, most of Tata companies do not pay a royalty against the Tata brand. So there are, so for example, a Starbucks pays a royalty, but to my understanding, every Tata company does not pay a royalty towards the use towards using that brand or towards using that trademark. So there will be differences there, and of course, some of those transactions can be structured in a more complicated manner. But it is possible that yes, a company retains a brand but sells the trademark. That's possible.
So Vikash, can you just extend this example and talk about, let us say, parachute? Okay, parachute is actually not only a trademark, but there is also a brand, correct? Parachute, the hair oil. So
Yeah.
is it that, how can you actually tell that, brand and the trademark can be separately divided and sold? If we take parachute as an example.
So again, it will depend on how the transaction is structured. So let's okay. So when we look at a trademark, right? I can always easily identify the cost of that trademark for me, isn't it? Most of that cost would be a legal cost. So the cost that I incurred in terms of getting that IPR trademark. So like I have a trademark registered for Omnifin, and there's an amount of money that we've spent on getting that trademark registered. And now that trademark can reside in my books at cost as an intangible, correct? But I still cannot record brand as an intangible in my books, isn't it? So a trademark is just the logo. Somebody may or may not be able to use that logo given the trademark rights that I have. But then a brand value is something which is so okay. What we look at is trademark is very, very tangible. We know that this is how it's going to look like. Brand is a little more intangible, but then not very intangible. You still look at brand, which is a physical identity of a company, and then we look at goodwill, which is an even more intangible. So it comes in stages. Now there are thin lines of differences. So if there is no transaction happening for Parachute brand, we might not be able to differentiate between brand and trademark Parachute. But only when there's a transaction, the terms of the transaction will determine how we will differentiate the brand and the trademark. Otherwise, they'll go hand in hand.
Thank you so much for this clarification.
So are you saying that trademark is a tangible asset?
I'm not saying it's a tangible asset. I'm saying that it has a bit of tangibility, right? So you know that this is the amount of cost that you've got to get that trademark. You know that trademark is coming exactly for this logo or for this name, but brand is going to be more than that, and goodwill is going to be even more than that, right? So if a company has a trademark registered, you can easily get the book value of that trademark recorded in your books of accounts, but you still can't do it for brand, right?
And
I
if
think
for trademark
when we
valuation,
more examples, I think it'll get even more clarified. But yes, go ahead. Yes, sir. Venkat, sir. Go ahead.
if for trademark valuation we adopt a method other than cost, say for example, with or without method for trademark also, then
Yes.
effectively the value, while splitting the value between the brand and the trademark, effectively we may come to a situation where the value of the trademark would inch closer towards the value of the brand itself, right? So the residual
Absolutely.
value will come down.
Absolutely right. Absolutely right. Correct. Yes. Yes. That's how it's going to be. So if you have to look at the fair value of the trademark, in case there are no specific restrictions on how the trademark can be used, the trademark valuation and the brand valuation would by and large be the same. But I think when we look at some more examples, I think that's where some of these doubts will get clarified. So, for example, the next one that I was coming to was that there is always going to be, so trademark, right? It by and large is going to be a logo, right? When we look at brand, this brand can be for a product or it can be for a company, isn't it? So when we're looking at product, it is going to be very close to the trademark itself. But when we look at company, that's how things would change, isn't it? So for example, we have a company which uses the same name, the same logo, but is selling different products under the same logo, right? So Parachute sells hair oil, plain and simple. You would not, I mean, it's very unlikely that the company would come up with Parachute hair oil and then Parachute face cream and then Parachute shampoo, etc. Right? So that's where the difference would come in. So when we look at brand, we have to see whether we are looking at a product brand or we are looking at a company brand, right? So when I take different examples today, I think some of those questions will get clarified. Of course, there's still going to be an element of subjectivity, but let's look at it. So my first example is around the evaluation of a company brand, right? We can still apply it for products, but by and large for a company brand. So I'm sure everyone is familiar about the amortization method, right? We can look at how can we value a brand based on the amount of money that is spent by the company on the development of that brand. Now, how do you develop brand? So information around how much money the company spends on business development towards development of that brand, right? That is one of the methods which can be used. Of course, there are challenges with this method, but let's look at it. You still hear me? It shows that my internet connection is unstable. Can I keep going?
Yeah. I request all the participants to rename themselves so that the correct name reflects.
Oh, I think whosoever reached out to Subbarao saying that we're not getting got the link. We logged in using that link. We are appearing as Venkatakalla. I was wondering. So
you have to rename.
Oh, we can rename. Huh? Okay.
Yes.
Okay.
The 3 dots on the right corner.
Okay.
All right. So when we look at amortization method, right, of course, we know that the financial statements require us to expense the advertisement and business development expenses. But when it comes to valuation of brands, we can use the same amount for assessment of the brand value. Now, this part is clear to everybody by and large, but let's try to look at some of the practical aspects of it. So first, we have to see if the company has a strong policy towards advertisement, or is it just a one-off case, right? So some companies would be very unstructured in terms of how they spend on the advertisement. The others would have a very strong budgetary policy. They would say, okay, this is our annual budget. This is the way we are going to define the spend the advertisement spends and so on and so forth. So it has to be a structured approach by the company. We cannot just look at the advertisement spends from the financial statements. So we have to talk to the company and understand from them if it's a structured approach or not. Only if it's a structured approach, we can go it. So just the way when we look at valuation of companies, we always look at the operating items, right? And operating items represents the core of the business. Similarly, advertisement spend must be the core of the brand, then only we can use it. Otherwise, it's going to be a futile exercise. Second, also check from the company how they evaluate their advertisement spend, right? So for example, a lot of companies would have a very strong approach in terms of checking what's the yield on their advertisement, what is the yield on the advertisement from individual channels of advertisement, right? So somebody would say we have a very strong, so we are spending on social media, we are spending on email marketing, we are spending on local area marketing, we are spending on hoardings and television and so on and so forth. And we have a structured approach to evaluate which channel gives us good returns or poor returns for which products. So if it's a multiple product brand, it'll be like a matrix, right? So we have to go through those records as well to see what is the return on advertisement spend. If the advertisement spend is not giving you a good return, again, that means that the advertisement is not yielding any value towards the brand, right? So we must ensure that the advertisement spends are yielding some positive results for the company. But need to segment the advertisement channels and identify benefits from each channel over a long period. We've taken an example from one of our recent cases. We've kind of simplified it, but that will help us understand it. Also, the advertisement spend, a lot of companies, especially private companies, we see that a lot of expenses goes into advertisement or business development spends, wherein they are not necessarily spent towards building a brand. For example, there are discretionary spending. So you will have those Durga Puja, Diwali, Christmas festivals where companies are giving a lot of charitable funds, and most of those charitable funds goes under are accounted under the business development expenditure. So see whether those are cultural spends with no benefits at all. Second, if companies have payments towards political spending, again that goes under brand business development expenses for many companies. So again, ignore those kind of expenses. Companies also gives kickbacks and referrals. So so those sales commission, etc., right? Or sometimes you are giving some money to the potential client as a kickback or a referral. So again, those kickbacks and referrals are not going to build your brand. So ensure that you are doing a proper due diligence of the accounting numbers that is recorded under the business development expenditure or advertisement expenditure. Okay, once you've done that, you get very clear picture around how much money the company is spending. Now I have an example here. I hope you can see the screen clearly, right? So let's say we are talking about a company which has spent so much amount of money on advertisement, right? So 2016 to 2021, so this is search engine optimization or social media marketing. 2016 they did not spend anything. 2017 they spent 200, then 800, then 1500, then 2000, and then 2005, right? Similarly, we got this money. So ignore this. I'll come to this for now, right?
You not share your screen.
I have not. You can't share my screen. You can't see my screen.
No, I'm seeing you.
We can see.
Please confirm you can see my screen, because I'll be going through the Excel file. I have been going through the Excel
We can
file.
see, but maybe some settings. Would anyone like to guide Mr. Subaraidu? Which option should he select?
I'm seeing right now you speaking, Shilpa.
So
Actually, you have
ensure that
gone to
you have
this.
not pinned my screen, right? If you see a pin against my screen, you need to unpin that so that you can see the screen also.
Okay, let me try that. Thanks.
The screen is
Got it,
visible
right?
clearly.
The three dots on the right corner of your thing, no? Somewhere there you will get unpin option. Yeah, go ahead.
Yeah. Okay. So, for example, if you look at, so we've got a hypothetical situation. We've sanitized some of these numbers. So, company has spent so much amount of money on advertisement channels, on various advertisement channels. So, SEO, there was typically no spend in 2016, and the spend has gradually increased over a period of time. Second is local area marketing. We've broken that down into hoardings and billboards. So all the local area marketing that was done, right? This amount has been like by and large consistent or fluctuating. So 2000, then 2200, 2500, 2750, 3000, 2021. Nothing happened because most of the time was during the lockdown. So the amount of hoarding and billboard spends was much lower. Then television. So again, that's the amount. Physical events. Now we look at physical events, which were cultural events, right? These events were mostly money that was given to the societies or the cultural event for the cultural events, for which they did put up some boards, etc. But then there was practically no active campaign that was run there, right? So still, this is the amount that was paid. Then they organized some business events for which that's the amount that was paid, and then they organized some online events as well, right? Now we know that in case of amortization method, we need to identify what is going to be the duration of the benefit that the company will get for each of these spends. Now, we've seen in the past that some people or some professionals simply take a common number across all the advertisement channels. Now, that's not appropriate. So we are saying that for SEO and SMM, the benefit of this advertisement spend is going to be accruing only for 2 years. Hoardings and billboards will accrue for 3 years because it's more local. Television has a even long-standing retain factor, right, or brand recall factor. Cultural events, we said this is zero. You're not going to get any benefit out of this with respect to brand valuation. Online physical events for business, these were direct events where you reached out to the customer or to your clients directly. So it might stay for 3 years. And an online event, again, it might stay for 3 years. Now this 2, 3, 4 is something that is very, very subjective. There is no standard for it, right? And this would change from company to company. So for a what should I say, for a B2B brand, this might even stick longer, right? For a B2C brand, these things would work better. For a local brand, the hoardings and billboards will have a long-standing impact. But for a global brand, this amount might have to go a little higher, right? Otherwise, it might not have a recall brand, etc. So that subjectivity would have to be built in. Okay. But assuming that these numbers are how it's going to go, we look at the contribution of each of these channels towards the brand value. So how would we do that? So we are saying that the SEO SMM spend is going to be available for only 2 years. That means any money that was spent in 2019, 18, 17 is gone, right? That's not going to yield any benefits. It's all amortized now. So look at this spending as CAPEX, right? If you look at each of these spendings as CAPEX, how would you amortize this? So we are saying that the life of that intangible is 2 years. That means anything that was spent in 2019, assuming that all of these spends are done at the end of the year, right? So 2019, the entire money is exhausted by the end of 21. 2020, 50% of it is exhausted, 50% is still there. 2021, the entire amount is still there. All this is assuming that it happened at the end of the year. If it's middle of the year, of course, you will change that accordingly. So this is how you would calculate this. So for SEO SMM, we are saying that in 2021, 50% becomes my amortization factor. How do you get that? 1 divided by the number of years. Everyone's okay with this?
Yes.
Yeah. So that is going to be my amortizing factor. So how much money would be left in the first year? I am saying that, so we use a function, you can do it manually. So we're saying 1 minus D29, which is the amortization factor into the number of years, right? So this means my 100% will be unamortized. I again repeat, this is assuming that this happened at the end of the year. Practically, we sometimes take it middle of the year, sometimes we take it end of the year. So 100% remains unamortized. For the previous year spend, that is for 2020, we are assuming that 50% of it is going to be amortized. So only balance 50% is going to remain, right? So SEO SMM channel is contributing to the brand value to the extent of 3,500. Is this part absolutely okay? I think that's the core of the amortization method, basically, in terms of calculations and how you are able to.
I have.
Yes.
In the accounting books, will this actually be expensed out?
Yeah, of course.
It is an expense, but then for the purpose of brand calculation, we are taking it as to be amortized.
Exactly.
This is
Exactly.
just our calculation, nothing to do with the actual accounting books.
Yeah, absolutely. Right. So your actual accounting books will only give you this number, right?
But Vikas, sometimes it can also be treated as deferred revenue expenditure in the books of accounts if the expenditure
Yes.
is large spend, right?
Yes. But then, so see again, so deferred revenue expenditure may have different explanations. So I think it's important. So we cannot do this calculation for a company where we are not able to talk to them. Okay, that will be a much more approximation number. So we can only do it when we are able to talk to the company. Number one, we will have to find out this information from the company, right? It will require discussions about the business model so that you can identify these number of years. Otherwise, for all the other companies, this is all going to be one, no? It will all be amortized in the same year. Am I clear? Is that okay with everyone?
Yeah, I just have one question.
Please.
Assuming it is actually, it is there is a spend on TV, and there is a budget, and the money is being spent, and for the purpose of accounting, they are also treating that as a deferred revenue expenditure, where they believe the benefit will actually accrue over a period of years. So when we are doing this brand valuation, can we actually have a different assumption than what the management believes?
Yeah, of course. See, so I think as a valuer, you would own the assumptions towards the valuation of the asset that you are valuing. Let's be very clear about it. This assumption may not be something that is coming from the management. It should be your assumption. So the management may feel, no, I'm spending on online events and I will get this benefit for 5 years. In which case, your value of the brand will keep on going up, right? So it has to be your assumption. Of course, the management will give you inputs, but then when we are doing a valuation, we have to ensure that we are arriving at a fair value. And the management's assumption will never be sacrosanct, because you have to remember that they will always have a bias towards their own business, right? So we've had situations where a company came and said, Vikas, we wanted to do the brand valuation. I said, yes, we'll do it. During the exercise, they felt that, no, Vikas, our brand valuation should be like 100 crores. I said, no, it is not going to be right? And we closed the transaction, right? So it is going to be our assumption at the end of the day.
Sure, thank you.
Yeah. Okay. So you've got how this calculation is done, right? I think this is where, from a practice standpoint, you would need some more understanding. So I hope this part is clear. Similarly, we said that, see, if the company is spending a lot of money on hoardings, right? So we are saying that this hoardings and billboards, the benefit will accrue over a 3-year period. Why? Why 3-year period? Why more than SEO, SMM? Because SEO, SMM is blink and you miss, right? So you are just scrolling your phone and you see an SEO, you see an advertisement, you scroll it up, the visibility factor is much lower. For hoardings and billboards, you might be going through the same place again and again. So if you're familiar with how the advertisement things work, if you're putting up a hoarding, that hoarding remains there for at least a month. That's the standard that is followed. So for an average commuter, right, this commuter is likely to see the billboard and the hoarding for the entire month, if not more. So the recall factor always appears to be higher in case of hoardings and billboards. But at the same time, we have to see what kind of brand we are valuing. If we are valuing a national brand and the hoardings and billboards are set up only in some urban areas, the recall factor, the total recall factor from the hoardings and billboards is going to be lower, right? So you might also want to put a probability factor where you see what's the weightage for each of these channels, right? We have not put it here, but you may want to put a weightage. If you're looking at a national brand, you would say SEO, SMM, the weights is going to be probably, let's say, a little higher, right? So you might want to put a 5 weight here, whereas a billboard and hoardings would have 2. TV again would be 5. Physical cultural events could be 1, right? Business events could be again 2. So again, you will take weightages like that. Am I okay with this? I mean, are you understanding where I'm coming from?
So when you're assigning weights, you mean to say that the revenue that is generated out of this spends will be proportionate to the weights that is assigned.
So not really revenue, but yeah, the contribution towards the brand.
Okay. Ultimately, it has to translate to revenue, right? That is what it is.
No, so advertisement method, so we do not compare this against the revenue. See, revenue part is something that you will do as part of the due diligence. You understood that, okay? But you may not get an immediate revenue from these spends. When we're looking at, once we have identified that yes, branding is contributing to some revenue, the weightages might not necessarily be to, I understand where you're coming from. So yes, we'll still take at revenues, but essentially we are talking about the contribution of these channels towards the overall brand building. So the revenue could be deferred revenue, the revenue could be immediate revenue, it could still be both, right?
Correct.
So for example, you see a lot of these companies, startup companies now, they all understand that only spending in urban areas would not work. So what we are seeing as a trend is that in almost all the pitch decks, all the D2C companies, they are saying that we are reaching out to the tier 2, tier 3 cities. But when you actually go to tier 2, tier 3 cities, they do not have the supply chain, they do not have any presence at all, right? So while they are promising that we are going to be in all the tier 1, tier 2, tier 3 cities, but actually their presence is not there. So if you've not put up a hoarding and billboard in a tier 2 city as well, how are you going to contribute that towards your brand in the tier 2 city? So your TG is there in the tier 2 city, but your hoarding is not there, right? So your spending is more big in the urban areas, because in the urban areas, the cost of hoarding is going to be higher. In the rural areas, the cost of hoarding could be comparatively lower, right? So that qualitative assessment will have to be done. And like I said, it is not an official standard that this is exactly how you have to value. Am I okay? Am I communicating with you?
Yes, Vikas.
Yeah. Okay. Great. So see, so for example, in hoardings and billboard, we said that the amortization would be for 3 years. So so everything that was spent in 21, 100% of it remains. Anything that was spent in 2020, only 67% of it remains. And for 2019, 33% remains. Right? Oh, sorry, this number should have been multiplied. Oh, sorry, my bad. Yeah. So there's a calculation error, formula error here. So this should come from, yeah. This is how it's going to remain. Okay. So this is how we would calculate it for all the companies. Now I realize that there is a formula error in all the goods. Instead of E, it should be. Okay. So this is how it's going to add up for all the channels. Any questions on this?
We have not used the weights till now, right?
I haven't. So yeah, in my example, so in our case, we did not use it, right? But I said we may have to use it for some other engagement.
But I see that there is some kind of correlation between number of years and weights.
Okay. So I'll tell you why. So there may be correlation, but so okay, these are, first of all, the weights are hypothetical numbers. The reason why I put weights as separate to number of years is the benefit of this channel that will accrue to you as a company, as a product, as a brand. Okay. Weight is something that where each channel might have. So every company does not have a very structured approach towards how the advertisement spend is made, right? And especially if you are looking at startup companies, etc., right? They would be very high on SEO, SMM, but their hoardings and billboards will only work for. So let's put it this way. We've
so I
seen
think
that
the weights are kind of relative to each other, whereas the number of years is a kind of a absolute assessment of the benefit that each would do. No?
Yes. Okay. So I'll tell you where I'm coming from. Okay. Why we say that number of years and weights would be different. So for example, we saw in one company, while doing our due diligence, we realized that the company was constantly saying that we are operating in tier 2, tier 3 cities. Okay.
Okay.
They said we are doing so many advertisement events, etc., etc. But the ultimate objective was to get funds from the investors, right? Now the investors are not going to a Lucknow or a Baroda to see how the company is spending, right? So the investors, so what the company did, they put up all the hoardings and billboards in Mumbai city, in Delhi city. That's where the investors were coming from, which of course led to a high amount of money that is being spent because the hoarding cost is very high there. But in Baroda or Lucknow, there was no hoarding at all.
Okay.
Now, if the company is expecting that a majority of its revenues will come from, of course, it's coming from the entire company, but if they project that a lot of it will come from Baroda or Lucknow, and they are not putting up a hoarding or billboard, at a total level, it is contributing, right? But the weight of hoarding would comparatively be lower, right?
Okay.
Because your customer is there, but your spend is not there. You understand where I'm coming from? So that's again. So we saw that in case of TV, if you know how the TV advertisements work. So let's say one very popular, one very popular TV program is Kapil Sharma show, right? Now Kapil Sharma show comes on weekends, Saturday, Sunday. It also comes on Sunday, where the entire day Kapil Sharma show is running. Okay. Now I don't know if Kapil Sharma show also comes during the weekdays. But if you are spending on the Kapil Sharma show on Saturday, Sunday, which is the prime time, the official time for Kapil Sharma show, the yield is going to be higher. If you're only spending on, let's say, weekdays, 3 p.m., 4 p.m., the yield is going to be lower. Correct?
Yeah.
So what's the quality of that spending will determine the weights. Again.
So I have one question on weights. Should the sum total of all the weights be equal to, like, say, 100%? Or it can be any random number?
No. Okay, so let me give you that example. Give me just one more second. So when we say, let's say this is 4, right? So now you've got 5 by 19, right? So it will sum up to 100% anyway, isn't it?
Okay, ultimately it has to translate to
so
100%.
I am putting random numbers. I'm very poor with maths, ma'am. So please bear with me on that, right? So ultimately it will sum up to 100%. Okay.
Thanks for this clarification.
Whatever way you take it. Okay.
Good morning.
So that's
Mute. He is muted.
Somebody is muting me again. Sorry. Am I audible now?
Yeah, Chavan, can you make me the co-host? The host, Chavan, I'm asking him to make me co-host. Okay, thanks, sir.
Vikas,
yes.
I have one doubt. Now, I think we are discussing about the brand valuation based on the spending and also various advertisement. Assuming that there is a company, a 30-year-old company, already they built a brand, they're not going to spend anything other than participation in exhibitions. They say that my brand value is, say, 50 crores because like taught us, if it is a brand is given. So in such a case, this expending not there. How do we value the brand?
No, we look at the valuation methods then, sir. Right. So this is one of the methods we are discussing. We are going to discuss 2-3 methods today. So this is one of the method. Of course, if the company is not spending on advertisement, this will not be a good indicator of its brand value. Also, there is a challenge with the amortization method that it is only historical in nature. No. So for example, when we look at a brand value, we have to be, whenever we're looking at valuation, it has to be forward looking. So the limitation of amortization method is it is only going to look at past numbers. It is not looking at future numbers. So amortization method is almost always going to give you a very conservative estimate of the brand value. It is going to give you a conservative estimate. So most people or most startups or most young companies would not like to take this as brand value. But this can be your base value, the minimum value of the brand that you can look at. Okay. So yes, there is a limitation with amortization method because it is purely historical in nature. We look at other transaction methods as well. Can I go to the next method now?
Yeah.
So the second method is a market transaction method. Fairly simple to apply, but it's difficult because you will have to do a lot of market research here. Right. Again, this is an extract from one of the premium FMCG companies, one of the largest FMCG companies for which we did the brand valuation. Right. Of course, we've changed the numbers, so you don't know the exact figure, but this is how we did it. So, sorry, this is not rupees crores. So we looked at, so there were 2 types of products that were being discussed. One was a personal care brand with multiple products. Remember I told you about, let's say, so yes, last week we've done an exercise. I mean, it's still ongoing, where they use a name and they sell different types. So let's say Jaguar, okay, bathroom fittings. So you will see various types of products, bathroom fitting products within Jaguar, right? And all of those goes under the same brand. Similarly, here we did a FMCG company where it was a personal care brand, but multiple products within personal care brand. So we looked at some of the transactions over a longer period. This was done a couple of years ago. This is not a recent example. So the dates are older. We did this exercise in 2019. So these were the comparable market transactions that we looked at. We saw this as the target company. This was acquired. This was the buyer. This was the seller, right? The enterprise value for each of those transactions was identified like this, whereas their revenues were these. So we looked at EV to revenue multiple for each of these brands. Now you will observe that in some of these cases, you would see that the entire company was acquired, but the company's core product was this one product or this one brand. Okay. In the other cases, it was a brand which was being sold, not the entire company. So this is where a lot of subjectivity comes in. Is my example okay to everyone?
Yeah.
I'm saying that in one case, you would see that I run a small company and I manufacture a hair oil, and my entire company was taken over. So only the brand was not taken over, the entire company was taken over. But the company's value essentially was incorporated in the same product that I'm saying. It's a single product company that was taken over completely. Second, I could have 5 lines of services and I'm selling only one product or one brand to the buyer, right? So in both the cases, the essence is that the value represents the brand value. So the enterprise value to revenue multiples were identified. We saw whether this is relevant or not in case of personal care, right? So when we looked at the multiple products brand valuation, we saw that for the comparable transactions that we have taken, 2 transactions were not relevant. We said these are not going to be relevant. So we've taken the EV to revenue multiple, that is the same as price to sales multiple. Now, if you look at Ashwath Damodaran, he gives a very fundamental approach to calculating value to sales ratio. Okay. Now, of course, that is something when you do not have a comparable transaction, but if you have a comparable transaction, this is how we calculate it. So we found that we will take the median value of only the relevant transactions, not all transactions. Okay. So we saw that this company was too big and this was too dated. For example, this was in 2012, but we did our transaction in 2019. So this was too dated, but we could have still taken this, right? Because you see the revenue number is very close, but we decided it was too dated. We haven't taken it, but thankfully, again, it wouldn't have made too much of a difference even if we did take it. Okay. And this was a very big number. So we felt that this is not going to be relevant. So we have ignored this. So you take these multiples, multiply it with the revenue of the subject brand, and you get a brand valuation.
So Vikas, I have a question here.
Yes.
So in column H, when you're taking revenue, that will be the, and let's say that in each of these cases, this EV is as of October 18, the first one. And that revenue will be also as of October 18, or will it be the March maybe 17 revenue, 240? And similarly for us, when we are saying in row 13, I13, the revenue 100 that we are taking, which revenue are we taking?
So normally we take the closest 12-month revenue, right? Of course, for let's say when we talk about Vinny Cosmetics Private Limited, okay, when we have 750 as a revenue, we will have to take the revenue which is reported in the public domain. We may not have the opportunity of getting the exact revenue as on September 17. So if this transaction happened where they might have considered revenue as of, let's say, March 17, that was probably reported. So we can't do much about it, right? So if you can go to that extent and find out that information, great. Take the closest 12-month revenue, but otherwise you will have to take the reported 12-month revenue, because practically for all the private transactions, you will have to rely on what is there in the public domain, right?
Correct.
So that's how we.
But R can be rolling 12 months, correct? The 100 that is there, that can be rolling 12 months.
Yeah. R can be rolling 12 months. Correct. Absolutely.
Okay.
Yes.
Right.
Okay.
Thank you.
So this is how we arrived at the brand value for a single personal care brand, right? So we took a carve out just for our discussion purposes. If it's only a hair oil brand, right? So this was a hair oil product, this was a hair oil product, right? And this was also a hair oil product. So in that case, we only take the examples, or we only take the multiples which is relevant for that particular product. Even if it's dated, it's within the range, we take this. Is this part okay?
Could you explain this? In the first two cases, what
So
I
in
see
the
is it
first,
is actually when you say personal care, but why have you included row number 6 for arriving at the median transaction multiple? Am I reading it correctly?
So this was sorry. Oh, my bad. Yeah, we did not take this. This is ice cream. Correct. We'll take this. So this was ice cream. Sorry. In my example, I've included it by mistake. So these are the 3 numbers that we would take, which represented hair oil product, right? Or hair oil transactions, not a multiple brand transaction. So again, see, the approach is the same. The subjectivity involves around the quality of the valuation that you are doing, and the approach is fairly simple. The challenge with this is to get the transaction details, for which you require market research. So when we are looking at market transactions approach, the fee that we get is for the market research and the subjectivity, not for the approach. The approach is very, very similar, very, very simple. Okay, any questions on this?
Why is median taken? Why not average?
So
Because,
we do not take average. I mean, as a practice, I think most of us, we're not taking average, we're taking median so that the outliers can be evened out. I don't see there would be a lot of difference even if we took average for this.
Yeah, the measure of central tendency, median is better.
Yeah,
You're
so
not
I think
influenced by extreme
as
values.
a practice, most cases we are taking median only now. I mean,
Yeah.
average use of
and,
average multiples is getting removed.
for a median, the data sample should be larger, correct?
Yeah, I agree. I agree with you.
With the 3, with having 3 data points, the median could give a different result altogether.
Fair point. Yeah. So of course we've sanitized this for our example purposes. In some cases you can take median, you can take average. When there's more data, we should take median. Agree. Totally agree with you.
From that point, I was asking.
No, yeah,
Vikas,
great.
Vikas, sorry to take you back. I think one statement you made in that amortization method,
Yes.
just thinking about it. See, the more you spend, the greater the brand value. That seems a bit counterintuitive, because at times if a brand has been around for several years, they might only have to spend less because they know that already they have got a very strong brand in the market, right? Whereas a new incumbent who's trying to establish himself in the market might, as of now, have a weaker brand. So his greater spending might be driven by the desire to establish himself as a brand against, let's say, a more established brand which has been around for years, right?
Yep.
So the amount that a company would spend to establish itself as a brand could actually be inversely proportionate to the strength of the brand as of now, correct?
So that's an argument that companies give, but there are a lot of studies which have been which have made that, see, if your brand or if your business depends on, or if brand spending or advertisement spending determines the sustainability or the growth of your business, you will have to spend on that. So arguably speaking, brands like Coca-Cola and Pepsi have been around for like 100 years now, probably, right? So if that was the case, and there aren't too many players, right? So they could have said, hey, we don't need to advertise anymore because we know that people are going to drink Coca-Cola, Thumbs Up, Pepsi only. So if I like Thumbs Up, I'm going to have Thumbs Up anyway. So Thumbs Up doesn't have to advertise that. But that's not the case, right? If the company, because customers' preferences keep on changing. So if we are in a business which is like an oligopoly where there are not too many players, too many sellers, then I can sustain in the market without advertising for too long. But then if I am in a monopolistic or a perfect competition kind of a market, then I have to spend. And if I'm not spending, my market share is going to keep going down and I will go out of business at some point. So that argument doesn't hold.
Would you not have to, would a more reliable method not be to rely on some kind of brand recall studies or something like that
I'm
get
coming
done?
to that. Yeah, I am coming to that. So this is
Yeah.
one of the methods. I'm not saying this is
Okay.
where we would apply this in all the cases. I am coming. Yes.
Okay.
Yeah. So we are okay with market transactions approach as well.
Yeah.
Yes.
Fine. Yeah.
All right. Third approach, a very common, well-explained approach. This is at least theoretically speaking, this is a very, very good approach. We use a relief from royalty method. Right? Let's try to see an application of this. Now, what is the relief from royalty method? It says that if you did not own your own brand, if this brand was held by somebody else, you would have to pay a royalty to the brand owner, right? So how much money are you saving by having that brand on your own? Let's look at the present value of that. That is how this method comes up. Everyone's okay with the concept of relief from royalty? If we did not own this brand, somebody else was owning this brand, we would have to pay royalty to the brand owner. So by owning the brand, how much royalty we are saving, we have to look at the present value of that. That's the relief from royalty method. Right?
But the same case, like you said, Starbucks is paying royalty to Tata's, correct? Because they are not owning the brand.
Okay, so Starbucks in India is a Tata and Starbucks joint venture. So there is a nominal amount of royalty that gets paid to Tata. There is a royalty that gets to that I'm sure that goes to Starbucks also. Now, I am not familiar as of today if Starbucks runs its own brand or own stores, or does it operate on a franchise model. But let's say you run a Starbucks store. Okay. In order to operate that store, you would pay a royalty to Starbucks, right?
So it's like a franchisee royalty payment.
That's the concept. Because, yes. That's how the concept
works.
Because
I become a franchisee of the other person, I have to pay royalty.
Exactly.
To use his name. Okay.
Now, see, so when you are a franchisee, you are not owning the brand anyway. So you cannot value that brand. But when you are the franchisor, then how do you calculate? Okay. So now there are two ways of looking at it. If I am the franchisor, I can say, hey, what is the present value of my royalty income? Isn't it?
Yes. Yes.
But then that is one way of looking at it. But the relief from royalty method goes the other way. I don't know, whoever designed this concept went the other way. They said, if I had to pay the royalty, how much money am I saving? I said, why don't you look at the income approach, right? But we'll come to that. But technically speaking, when you apply a relief from royalty method, the concept is how much royalty are you saving by having your own brand instead of using somebody else's brand. Is the concept of
I have one question, Vikasji.
Yes.
Recently, one customer approached me. He has a two-wheeler business. The two-wheeler is sold under a brand name. Now, he wants the valuation of the brand both with IPR and without IPR. Now, when with IPR, I can apply this RFR method. Without IPR, what method to apply?
So without IPR, you have to value the business. You cannot value the brand without the IPR. Because the brand, so the IPR is going to be an integral part of the brand. Isn't it? So see, you're saying it's a two-wheeler. So let's say it's a scooter business. Okay. Now, if I can manufacture any scooter I want, so how will I value a brand without the scooter brand name? So if I'm using an Activa, or I mean, we used to have Bajaj Vespa at some point. So I think the product will sell based on that name also. So if you're valuing the scooter brand without the IPR, you're not valuing the brand, you're valuing the business.
Okay.
Right? It's going to be any scooter then.
Okay, now what happened that they are selling the scooters outside India to some developing countries, and that thing will continue. Now they want to sell the brand with trademark and also without trademark. With trademark, it's understandable because trademark is registered within India.
Yes.
And without trademark, when they will be
so
sold.
Trademarks are also international. So we will have to see whether the trademark is national trademark.
These trademarks are national trademarks. Now, when they will be sold outside India, I think this trademark cannot be used. So they want to know both with IPR and without IPR. With IPR, I understand. I will apply this RFR. Without IPR, then I have to value the business without considering this relief from royalty method.
Correct. Yes. You see, if the trademark is based in India and you go to Spain and say, hey, I'm going to sell the same brand, you will not leverage on that brand in Spain, right? You would have to spend money in Spain to leverage on that brand. Yes, you will advertise there saying that we are a major brand in India. We have now come to Spain, but then you will have to advertise on that. You will not be able to
It is not sold in European countries. It is sold in Nepal, Bangladesh, and some African countries.
Whatever. So I'm saying that if in the territory where you are going to sell, there is no existing recall value, you will not be able to leverage that brand.
Exactly.
You go without IPR then.
I got you.
So we have an adjusted RFR which we work on, right? I'm going to talk about that as well. Let's quickly look at the RFR method and then we'll move to, I think that way, Mr. Das, your question would be even more clarified. Okay, let's come to that. So first, for a relief from royalty method, you need the royalty rate. Now, this is the biggest problem for companies for businesses where there is an established franchise model. You can easily get the royalty rate. Where you do not have an existing franchise model, that's where the trouble starts. So I'm going to share some research papers or some indicators of how can you identify the royalty rate. But let's say you have the royalty rate. Okay. So the relief from royalty method works in this way. So you have a royalty rate, you have a tax rate, you need a discount rate, you need a terminal growth rate, if at all it is going to be sustainable in the future, otherwise not. And you also have a tax life. So we'll go to that. So let's say the product sales excluding this, that's the net sales. Okay. The net sales is this much. So this is the projected sales. So it will require you to project the sales. Remember in our previous transactions, previous methods, we said that amortization method is backward looking. It is talking about the money which has already been spent, but we have to look at forwards as well. So the company has projected these as the forecasted revenue. Now royalty savings is whatever money you would have paid as royalty on the sales. Okay. So how much is your savings? So royalty savings is net sales into the royalty rate. All right. So you would have saved 5% on this. So this becomes your cash inflow basically. And this becomes your tax. So how much taxes you have also saved? Okay. Because if you would have paid a royalty, you would have also gotten a benefit with respect to tax because it is an expense. It is a tax deductible expense. So how much is your tax saving? All right. Everyone's okay with this? Yes or no?
Yes. Yeah, correct. Yeah.
So you would have paid a royalty, and because it's a tax deductible expense, you would have also saved some taxes there. So what is your after-tax royalty savings? Oops, sorry.
So Vikas, one question in here.
Yes.
Royalty rate remains static for all the forecasted period, or I mean generally
Normally it is. Normally, yes. But of course, if there is a business where you want to you see that this royalty rates might change, it might change. But in most cases, we've seen it falls within a range, so you can keep it static.
I think your earlier formula was right. You would have to reduce the taxes, not add. Yeah?
Sorry, I'm confused. Yeah, I'm getting.
Yeah.
So this was right. Okay. So we look at the present value of this. Basically, we take the NPV based on the 17%. We also take the terminal period. Now, we have to be very careful when we take the terminal period. Okay. It's important to understand that you cannot take terminal period in all the cases. You have to see the nature of the business. Why is this important? And you see, of course, we know that terminal value is going to be a very high number always. This is where a lot of people make estimation issues and the brand valuations can change heavily, right? So why cannot we take terminal period? Why should we take only the explicit period in most cases? This comes from the normal economic concept that when we're looking at a brand value, we are talking about an extraordinary advantage over a normal business, isn't it? Am I right? Are you with me?
Yes, sir.
Yes?
Yeah, correct.
So how many brands do you think will be able to sustain that advantage for an infinite period? That's not going to happen, right? Because 70% of the businesses close down in 10 years' time. Correct? So if you're valuing a brand and you're saying that I will have, so when we are saying explicit forecast period for 5 years, right? We are saying that I'm going to get a sustainable advantage for the next 5 years. Now, arguably, you can say I'm going to get it for 10 years. But if you said I'm going to get a sustainable infinite years advantage, that means that not only your business will continue, you will continue to get a very, very high extraordinary return for an infinite period. Now, theoretically speaking, this does not make sense when you are saying that your terminal growth rate is only going to be 6%. Right? So whenever we take, even when we look at DCF valuations, we always try to ensure that our terminal growth rate is normal within 5, 6, 7%. We always try to ensure that our margins, the net profit margins, etc., is also within the industry range, isn't it? Are you with me?
Yes.
Yes. So therefore, while I'm showing this to you, because it's a conceptual point, but practically speaking, please be very careful when you're applying a terminal growth rate, because your brand valuation, the sustainable advantage, will not grow at 5% forever.
So then we can have two periods, correct? Let's say that we forecasted for 5 years and we estimate it is 10 years.
Yes.
We do another 5 years and then be done with it, correct?
Yes, yes, yes. Because let's understand, and I'm telling you this, there's going to be a lot of pushback from the clients and some of the other professionals, but we have to have our argument strong. Let's say we look at a restaurant business. There is no restaurant, I mean, 99% of the restaurants close in 5 years to 7 years time frame globally. Okay, globally. Now, we all have been using Colgate and Pepsodent and probably some of those common FMCG brands, but those have been established, right? But can you recall any brand which came into existence maybe 5 years ago or 10 years ago and is still very popular? It's just not there, right? So those brand valuations will not sustain for a very long period. When we look at some of those international assignments, so when we do some of these assignments in US, etc., there they take a standard of 15 years. They do not take it more than 15 years. But that means they are projecting it for 15 years. Are we okay with this? Clear?
What if the brand that we are valuing has already been around for a long time? So they would say we have historical data to support our claim that, competitors have come, competitors have gone, but we have weathered the storm for the last 20 years, and we believe so they would have evidence of the fact that they've been around for so long years, and therefore they could say that, yeah, we can support with data that,
No, yes and no, sir. I understand where you're coming from, but let's look at it this way. Okay. So let's try to talk about some of the brands. So we talk ITC as one brand and Tata is one brand on one side. And we talk about, let's say, any family owned brand on the other side, right? A brand sustainability in most cases is restricted to 2 generations, not beyond that. Do you agree or not?
No, but supposing assignment specific, supposing.
Give me a minute, sir. Just 1 minute. Okay.
Yeah.
So what happens is, I set up a brand when I was 25. I worked for 30, 35 years and I have built that brand.
Yeah.
My son or my next generation also worked on it, but the third generation is not interested in continuing that brand. So I may have a history of the last 20 years, but that 20 years will continue for the next 40 years is never sure. It's never the same. Having said that, I can still take your point when we say that, yes, we have a very, very professional board or management in place, like the ITCs and Tatas.
Correct.
And there is a very clear picture that this brand is going to continue in the long run. It is not dependent on a family. If it is dependent on a family, it will not continue for the next 20 years.
Okay.
So I think that's how we make our qualitative arguments. Please go ahead, sir.
No, fine. Go ahead.
Yeah.
Is my understanding right that in case of a family-owned brand, rather a professional board, there we can have a terminal period, or else it has to be verified?
No, arguably we can have a terminal. See, that's why I've put it on the slide. No, so we can have a terminal period, but again, look at it from a qualitative perspective. Also, normally in those cases, our terminal growth rate would be somewhere around 2%, 3%, not very high. I mean, don't take a 5% or a 6% terminal growth rate that we normally take. I mean, we can, but normally we try to refrain from that. So see what happened in case of the likes of Kingfisher and all. No, so the brand valuation was exaggerated a lot. So my only point is that sometimes we end up exaggerating the brand value. So we have to be careful around that. That's the whole point I'm trying to make. But yes, you can do it like that. Okay.
Yeah.
Can we go ahead? Okay. So there's another concept in the RFR method. Now, I have to admit that we don't always apply this, but internationally this concept exists. So I'm explaining this, okay? Practically, we don't apply this. This is called the tax amortization benefit factor. We might have some international engagements coming up, etc. So what's the tax amortization benefit factor is that whatever value we have calculated here, right? Now, even if it is after tax, there is a benefit with respect to intangible assets for in terms of tax, right? So there is an intangible tax benefit that you get in some companies. So for example, in India, I remember earlier we used to have it. We don't apply it now. In US, the intangible assets have a finite life of about 15 years, right? In India, it used to be around 4 years. So after we've calculated the PV of cash flows, we also calculate a tax amortization benefit factor. This is how it is calculated. Okay. It refers to the PV of the income tax saved resulting from the tax deduction generated by the amortization of an intangible. So right now, think about it. You are not recording your brand in your books currently. Okay. If I am acquiring your brand, that means I'm going to pay for that intangible asset. Correct. That intangible asset will reside in my books. So, and this intangible asset will be subjected to amortization over a certain period, isn't it? So under income tax, a brand amortization is allowed for 4 years period. Okay. In the US, it can be 15 years also. So whenever I'm paying this money, I'm going to get an additional tax benefit on the acquisition of the brand through amortization. So I'm calculating the tax amortization benefit factor, right? This is how it's calculated. Okay, so it is 1 divided by 1 minus tax rate divided by the number of years, which is going to be 4, multiplied by 1 by cost of equity, that's the discount rate, minus 1 divided by cost of equity into 1 plus cost of equity to the power n. It's fairly complicated. I don't know if I can, I don't know how to put this here, but we calculate a tax amortization benefit factor, and your value of the brand can be plus the tax amortization benefit factor. So usually the sellers of the brand would want this. The buyers of the brand would not want this to be incorporated because then they would have to pay this money.
So I have a question here. When we are calculating this tax amortization benefit, should we actually, I know we are taking the present value of the cash flows, which is net of tax, right, for the explicit period, and the same thing holds good for the terminal period as well. And to that, present value of cumulative present value of the cash flows, we are applying this tax amortization benefit.
Great question.
Yeah, so since it is already reduced, should it actually be the royalty saving and not the after-tax royalty saving? What should be the right amount?
So yeah, when I looked at this, we also felt that this is double counting, but it's actually not. So see, when we're looking at the after-tax royalty savings, we are saying that in what is going to be my cash flows from the intangible brand. This is my accruing cash flow, right? So if I would have paid royalty, this is the tax that I would have saved. So this taxes is the notional tax that is being saved if we had to pay a royalty. Okay. However, this tax amortization benefit is once you have identified the value of the brand, this is not royalty taxes. This is if I have to, when I'm acquiring a brand, I am paying an amount of money to acquire the brand. So this brand will reside in my balance sheet, no? And when it is there in my balance sheet, I will be amortizing this brand value over the next 4 years period, for which I will save taxes on the amortization. So if I am the buyer, I would want to pay this money, plain and simple. Okay. But if I'm the seller, I will say, hey, when you acquire my brand, you will also get tax benefit of this percentage, of this factor. I want this money as well. You understand where I'm coming from? So this is the amortization of the intangible, not the cash flows. Those cash flows are just used to calculate. I mean, this taxes is just only for the cash flow calculation, nothing else. This is the actual benefit that you would get, no?
So actual benefit that, but it is restricting, and maybe the actual benefit that I'll be getting will be beyond 4 years. But for the
No,
purpose of
purposes.
calculation,
Yes,
we are
income
actually
tax
taking
allows
it
it
only
for
for
you to
4
amortize it
years.
for 4 years only. Yes, that's.
Okay, maybe we should do it once and then understand how it is actually
Yes.
done.
But you will find this equation. If required, I'll share this tax amortization benefit factor calculation.
So what I understand is the tax rate used in row number 16, which is relief from royalty, the row number 16, taxes, row number 16. Okay. And the tax rate used in tax amortization benefit factor, right?
Yes.
Actually, they're two different. So the row number 16 is if the tax laws allow royalties to be deducted from taxable profits.
Yes.
Whereas the row number 22 is, do the tax laws allow amortization of intangible asset in the form of a correct?
Great point, sir. So this tax, so when we are using the tax amortization benefit, the effective part is the life, right? But the tax rate would be different in that case. Agree. Totally agree. Yes. You may not use the same tax rate. Like I said, we don't apply this in India, but it was I have added this for your explanation, because if you are on the seller side, they might want this to be incorporated.
Okay.
I'm also assuming that the valuation date in this case is March 31, 2021. Is that correct?
Yes, yes.
So, and the forecasted period is actually for 1, 2, 3, 4, 5 years.
5 years in our case.
So the question that, no, okay, one other connecting question is, see, we have taken the explicit period to be 5 years, but the tax amortization benefit to be 4 years. Should it actually be 4 and 4, or is it okay to be 5 and 4?
No, it will be 4 only. It will be 4 only. So the tax amortization benefit is dependent on the tax life. It is not dependent on your explicit forecast period. So this will come from regulation. So
yeah,
if you
so
were
that for
doing the same
TAB it is
exercise
4 years, I understand, but for present value of cash flows, you have actually taken 5 years, right? The explicit period in this case is 5 years. Is
Yes.
that the correct, or should it, just to align that, should it have been 4 years instead of 5 years?
No. Okay. So till this row, right? All this part that we are doing is purely finance. It could be 15 years, it could be 10 years, it could be 5 years. This is purely finance based on how much amount of forecast can you, how much amount of cash flows can you forecast or project. Okay. This has got nothing to do with regulations. This part is purely taxation. When we are looking at the tax amortization benefit, it is purely taxation. So for example, if the same exercise was done in the US, the life is 15 years, the tax amortization benefit factor would change. And you would take 15 years even then.
In India, as of now, we don't have tax amortization benefit.
It is for 4 years. For brands, you can amortize it for 4 years.
Yeah, so the tax life in row number 8 impacts the amortization benefit in row number 22, but is not linked to row number 16.
No, it's not.
Correct.
So what I should have done, all right. So what I should have done was the tax rate for intangibles, I could have taken some other rate. If I take that as 25%, and I change this formula to say that this is going to be this percentage, that's how it works, right? If it is for intangibles, if it is some other rate, you take that rate.
Yeah, I think I got a point. The 4 years has got nothing to do with the number of years for which you will factor in the after-tax royalty saving. That is more dependent upon whether royalty is allowed as a business expense deduction at all or not.
Yes, exactly.
Right. Yeah. But it does have a link to the tax amortization benefit. Yeah, correct. Yeah.
Is it clear to everyone? Anyone has any question here? Okay. So I think we'll move to the next part. This is a carve out from this, so this is an extension of the RFR method. But we also do, so somebody was talking about the qualitative factors and so on. So there is an entity, I forget its name. They have a brand score calculation method. So at Omnifin, we have our own. Yes, sir.
Just one question on RFR. So are we supposed to make any further adjustments for marketing expenses or brand building expenses as a owner of brand, which I'll have to incur to build that brand?
So this method doesn't require you to do that. The reason it is not requiring you to do that is that, see, this method is putting you in the shoes of a franchisee, right? And the brand belongs to the franchisor. So whatever spending you are doing for your business as a franchisee, it is not building your brand. It's an expense, plain and simple. And the franchisor, of course, makes a lot of expense. So I'm going to come to that example now. Okay?
Okay. Okay.
So I'm going to quickly talk about some of the qualitative assumptions that we make, right, when we do a brand valuation exercise. So there's a very clear understanding that brands usually enhance the performance of three stakeholder groups. So we have the customers, the employees, and investors. This is there in the public domain. This is not an omnifin, or this is not our whatever assessment as such, right? This we've not created this. It's there in public domain. When you look at some of the brand valuation exercises or concepts of brand valuation, you will see this literature there. So just to extend that, right? So we say that if you are a brand, you are going to influence the customer choice. You will create loyalty. You will encourage purchase behavior in your favor, right? If you're a brand, you will be able to attract people. You will be able to retain people. You will be able to motivate people. If you're a brand, you will be able to reduce the cost of your funding. So your cost of equity would get lower. Your cost of debt might also get lower, right? That's a very established concept when it comes to valuation of brands. Now, how do you assess that? How do you measure that? So in case of customers, for example, we try to see that, are you able to get a price premium? Now, what do you mean by that? If I sell any tea, right? If I sell any kind of tea, now you will get non-branded tea in the market, and then there's going to be a price of tea that you are selling, correct? So what is the premium that you are able to charge without affecting the revenue, without affecting the volume, right? So as a brand, I'm able to charge a higher price without reducing my volume. So what is the price premium that I'm able to charge? Or if I think that, yes, the market is very competitive and therefore I cannot charge a higher price. For example, look at those beverage companies, right? I mean, Coca-Cola, Pepsi, etc. They cannot charge a price premium, isn't it? But they get a volume premium, right? So if you come up with a beverage brand today, you will probably keep it at the same price as a Coca-Cola or a Pepsi, but your volume would be lower as compared to Coca-Cola or Pepsi. Premium that you are able to get. Also, service companies or B2B companies, we also look at what is the customer satisfaction factor. So we try to come up with customer rating. So that helps us creating a score. Next, similarly, I will do an assessment with respect to employees. I will check the attrition rate. I will compare the attrition rate against the peers, the number of job applications that we get when we come up with a job opening, right? The employee satisfaction surveys, great place to work or similar ratings, right? Glassdoor reviews, etc. So we again come up with a score with respect to employees. There will be an element of subjectivity there. Then we have investors. So some of the methods of calculating investor score is, you look at return on equity. You say that in the industry, the minimum return on equity should be positive. It should not be negative. In some industries, the minimum could be 10%, right? So you put a score. So if it's negative, the score is 0. If it's 0 to 5, it's 5, then 6, then 7, then 8, then 9, then 10. So you will have to come up with your own rating, right? This is an extract from some of the companies that we work for. Similarly, try to get a rating with respect to your debt. So if the company has a AAA rating, your score is 10. If the company has a AA plus rating, your score may be 9. An unrated company may have a score of 1. If there's no rating, you can go to debt equity ratio, you can go to interest coverage ratio, which also will give you indications of what kind of score you can assign. If the brand is dependent on online or offline presence, what's the rate? What's the amount of their presence? Remember, I spoke about tier 2, tier 3 cities. So the company expects a lot of revenue there, but the presence is not there. So the score will go down. It has a lot of presence, the score will go up, right? What's the differentiation in the company's product? Again, it's going to be qualitative. You may want to keep it, you may want to remove it. Also governance. Are there litigations against the companies, right? Receiving this brand. So based on all of these, we can come up with a score. Let's say this is a sample score that we came up with. Okay. So we say price premium not applicable, volume premium not applicable, customer satisfaction survey was 9, talent attrition was 8, talent attraction was 9, equity score came at 8, debt, there was no debt in the company, so it becomes not applicable, presence was 10 on 10. So it will change from company to company. That's how we did it. So you get a score, right? Which we said is 52 out of 60. Okay. So if the score is 86.67, I will give them 5. Now we'll have to explain what this 5% means. Is everyone okay so far? Is everyone okay so far? Because we're going to come to something very crucial here.
Can you explain the last part? Could you please explain the last part when you said that, okay, this we understood. Basically, it is a sum total of all the scores that you have actually assigned. There are 6 parameters, and for each parameters, let us say a 10 point is there.
Yes.
Out of that, and you've also rated against each against. Okay, yeah. So now we said I didn't understand the 5% part of it.
I'll explain the 5%. You understood till 86.67%, right? Everyone understood that.
Yes.
Yes.
Yeah.
Okay. Now, think about this. When we say royalty, right, we understand that one of the challenges of the royalty method is that it is assuming that whatever amount you pay towards royalty, that entire amount is for the brand. Isn't it? The entire amount of royalty payment is towards the brand only. Isn't it?
Yeah.
But
brand plus trademark also. I mean, when you say brand value includes the value of the trademark.
Right. But if you've ever worked with any franchisee arrangement, you will realize that that's not the case. If I am a franchisor, I have to put in a lot of effort as a service to my franchisees. So my royalty percentage is not only the brand percentage, does not amount to brand only. So for example, I will have to do some marketing on an ongoing basis. I will have to provide some services. I will have to provide materials, right? I mean, I will have to provide admin support, etc. So the brand factor is only a part of the royalty. It's not the 100% of the royalty, isn't it? Am I making sense or not?
Yeah, right.
So that's why we are saying that if my score is between 0 to 20%, the brand factor is only 1% out of the total royalty factor. And we did a lot of research and we found out that the maximum brand value factor is going to be 5%. We did not find any industry where the brand value factor is more than 5% of the royalty factor. Now, I am telling you that whatever value we arrived at using this method, the brand valuation is probably going to be only 5% of it. But yes, that's how it is. Okay.
So the 5% that you're showing in this table and the 5% that you're showing in that royalty, are they kind of linked? Is this 5 and that 5
different?
linked?
They're completely different. I will show you another example. We will take another 10-12 minutes to show you a different example. Okay. So we are saying that the brand score index factor is this. This is my brand score, right? This is 86.67%. So if it is 86.67%, it is falling in this range. I will explain what this 1 to 5% means. I'll explain that. But have you understood so far? We've understood till this point, right?
Vikas, can you please explain the 86.67%, please?
Okay, 86.67% is the score percentage. That's it. My score was coming 9 out of 10, 8 out of 10, 9 out of 10.
So it's basically 52 by 60 is equal to 86%, 87%. And that is falling within the range of 90 to 100%. And therefore, 5% is what you need to assign. It's basically some sort of a statistics that is being played out here.
So this that will come in 60 to 90%. Now, how can that be 90 to 100%?
No, you have to look at 86.
Oh,
Okay,
sorry,
yeah,
sorry, sorry.
correct.
Yeah, yeah, yeah. Sorry,
Absolutely.
sorry.
It's not 96, it's 86 is what I'm
It's 4%. Yes, yes. Sorry. We changed some numbers and then we forgot to operate. We should have used the formula here. Anyway, okay, so far? Yes. Now, I said that we talk about an adjusted relief from royalty method. Okay. This is what I mean. So I'm saying that let's say the royalty rate is 10% or whatever, it can still be 5%. Okay. So we are saying that this royalty rate is coming from the peers. This does not necessarily reflect brand value because it also entails service against the royalty. So BSI factor becomes 3%. That is, my brand value from the royalty is only going to be 3% of the royalty savings.
Just 1 second. The brand score is not a standalone method. It adjusted RFR starts from brand score, right?
Yes. So adjusted RFR is an extension. So basically in my RFR method, I had taken royalty savings straight away, right? Yeah. And I discounted the royalty savings only. But in RFR method, I'm saying, hey, this does not mean, this doesn't account for the brand valuation actually.
Okay.
The proportion of the brand in my royalty saving is only going to be 3% or a 4%. In our example here, let me link it from this cell. So it's only 4%. Are you with me?
Yeah.
And I'll tell you why we had to do this exercise.
Because I have one point.
Yes, sir.
There is one European valuation expert who advocated a thumb rule of 25% of the margin.
20%, 25% what?
Of the margin.
Of the margin.
The margin comes around margin for that particular this thing as a thumb rule. I have forgotten the name of that valuation expert, some German valuation expert. Now, suppose the average margin is a 10%, then he says the royalty rate should be something like 2.5%, which was coming closer to your BSI factor rate.
Possible, sir. But again, right? So of course, if it's a European researcher, his document and names have come out in public, he must have done a lot of research around this, right? Similarly, we've done our own research because I'll tell you what, when you look at this method, look at the royalty savings, look at the revenue of the company. In March 22, my forecasted revenue was 65,000. This could be millions, lakhs, crores, whatever. And look at my value of brand, right? This is huge, no?
00185. Mummy ke paas.
This is huge of my forecasted revenue. So you would say, hey, my revenue was 56,000 last year, and you're saying that my brand valuation will be 23,000. That's like half of my revenue. Doesn't make sense, isn't it? Are you with me or not?
Yes.
Yeah. So
Yeah.
see, at the end of the day, when you are doing an exercise, the method is just a tool. No, none of these assumptions are questionable. These are all very standard assumptions. Yes or no? So we realize, no, there's a strong limitation in the relief from royalty method as well, right? So when you said this is some percentage, we saw that the brand score factor, right? So now we have arrived, of course, it's a semi-objective, semi-subjective kind of a method, but then it's there. I'm able to establish this, right? And I'm able to incorporate multiple factors which does contribute to a brand valuation. So we said that if the royalty rate is 5%, the BSI factor is 4%, my brand value, now I'm using the same approach, right? I'm ignoring the taxes actually, but again, we will still look at the same considerations towards terminal growth rate. And we're saying that, okay, my PV of cash flow is 13,1359, or let's say all these numbers are in crores. So for 52,000 crores of forecasted revenue, my brand valuation is going to be about 13.5 crores, which makes sense now, isn't it?
No, but here we are comparing a multi-year number with a single year number, right? 1359 is the discounted value, yes, of future. Whereas 56,000 is a single year figure, right?
Sir, agreed. But then, okay, let's get back here. Put yourself in the shoes of a buyer, right?
Okay.
You will say, hey, you've earned 56,000 crores of revenue. The revenues are going to grow at 15, 17, 14%, whatever. You want me to pay 23,000 crore as brand value? What kind of numbers are we talking about here?
Yeah, practically these questions might come from the.
So that's the other reason why I
side,
said be very careful about the terminal period. Right?
Yeah, correct.
Now, again, let's look at the market transaction. Let's try to vet it. My market transaction multiple was coming as how much? 5% of the revenues, no?
Okay.
If this is my brand value, my market transaction multiple was coming at around 5% of the revenue. Now, this is in line with the royalty rates only, isn't it? If you look at most of the other companies, right, what the royalty rates normally range between 4 and 6%.
Okay.
Some companies, it can go up to 20%. So I worked for a company where we were the franchisors and we took 20% royalty like for 18 years.
Okay.
Right? Again, there's a lot of commitment from the franchisor in that case, but it's there.
Yeah.
Right? Let me, I'll take another 2 minutes of your time. I hope that's okay. Let me show you some statistics. Okay. You can still see my screen?
Yeah.
So let's say Franchisee India, right? They are one of the largest players when it comes to giving away franchisees, one of the largest players. So they say that most franchisees charge between 4 and 6% of the gross sales, though they can be much lower or much higher. Number one. Okay. So even if you're taking 4 to 5% for a typical company, you're not doing too bad. It's still okay. I am saying we have to take an even more logical approach to it. That's why we called a brand score index factor. Because see, that's the royalty rate. So if you believe that the entire royalty is towards the brand, you take it. You don't have to calculate a brand score index factor, but practically you would have to, right? Otherwise you can't just calculate the PV of the royalty as brand value. Let me give you another document. Tata Starbucks royalty rate. This is coming from some of our market research, right? Look at this. The fee range from 0.25% of the turnover, not exceeding 5% of the net profit from blue chip group companies to 0.1%, depending on the brand leverage. Joint ventures where foreign partner was offering its brand name gratis were exempted. Brand name gratis were accepted. So this is the fee range. This is what Tata's charge. Okay, anywhere between 0.25% to 0.1% of the revenue. I think there was a similar number given for Godrej also. Let me see if it's here or some other document. Yeah, not in this one. There's a KPMG study in 2012 that came up, and this is an international study, so this will not apply to Indian companies. But it again spoke about the profit margins rates from the 25% rule and the reported royalty rate. So the royalty rates was again 7% in most cases, or 5% in
Because see, this 25% rule was advocated by Gold Skyder in 2002. Now I got the name.
Yeah. Okay. Thank you so much. Okay. Maybe you can write the name in the chat window so everyone can get that.
Sure, sir.
Thank you so much, sir. Okay. So yeah, I think so this is another website, Franchise Byte. They give you some indications of royalty rate. So again, it's about 4% share of the revenue that goes to the franchisor in some cases. So most of it would be in the range of 4 to 6%.
The one what you are showing, is it available for public in domain?
Yeah, this is all our research that we've done. All this is public domain only.
It's available for everyone.
You will have to do some research, ma'am, but yes, you'll get it in public domain.
Now that we know these are the names, we can.
So you can look at Franchise India, you can look at Franchise Byte, and so on. I think that's about it from my end. I hope I was able to add some value. Any questions? I'm still around. I know we've exceeded our time a little bit, but yeah, happy to have any questions.
See, how do you handle this issue of possible double counting when you're taking the income? For example, if you're taking the income, right? The income estimates would include quantity, sales, and prices, right? If for the presence of a brand at times, the price that you'd realize and perhaps even the volumes would already incorporate the fact that the brand is present. Right.
So
Had the brand factor not been there, perhaps the assumed volumes or the assumed rates might not have been realized. So could one argue that if there is a brand value that is being added on top of that income, the brand factor is already included within uh, uh, the workings?
no, of course. So see, again, whenever we are doing any calculation, any projections, right? Those projections always include brand valuation. They always do that. I mean, if I have to exclude the brand valuation from those projections, I will have to take the projection from a local company. I mean, of course, right? If I am looking at my revenues and I'm projecting my own revenues further, I have always incorporated my potential brand value or the potential price premium or the volume premium in those projections. I cannot double count that again. So yeah, you're right. I mean,
yeah. So if we are taking the income approach to something, the quantities and the sales price per unit would have to be factored in. That this must be without the brand.
no. I'm saying, okay. So my March 21 revenue is based on a brand, right? Yes or no?
Correct.
Correct. So if I'm projecting the revenues, I am projecting my price and my volume, and I'm projecting based on the current price and current volume only. So therefore, it is already incorporated there. Now, okay, let me try to understand. Let me confirm my understanding with you. I am planning to buy your brand.
Correct.
So then whose projections am I going to take to calculate the brand value? Your projections, not my projections.
Okay.
You understand that, right?
Yeah.
Because the brand is residing with your company right now.
Right.
Because it could be the other way around also.
Projections, not my company's projections.
Because it could be the other way around also, because suppose
if I take it the other way around, then I will have to include the royalty income. So then I will say, okay, my projected price is going to be higher than my current price.
Oh, so one is royalty. What typically happens, I mean, I'm asking you, is essentially if I were to start a whatever new brand, new product, whatever in line, okay, it has its own time that it takes in. Essentially, what you're talking is a brand gives you an advantage of volume or on price, and somewhere it has to taper down. That's the rule of that. That's why till that point of time, you take the advantage of the brand. Now, if I start something now, for me, if I have a brand name on day one, if I generate 100 units of sale, assuming in volume terms, if I don't have a brand name, I may start at 50 units or 25 units. That advantage of brand name gives you. So the advantage of having a brand name on year one is much higher than the advantage of having a brand name in year 5 or year 7. So when I think one of our colleagues is asking here, from our perspective as a buyer, when we see how much value I want to take assigned to that brand, that if I were to take it, I look at what is it that takes for me to reach to that particular level, and depending on that, I assign a brand value. It's not royalty here.
I get your point, but then I have it's a very interesting point that you're making. But see, first things first, when am I valuing the brand today, right? Yeah. So it is going to be a huge estimation issue if I'm saying that, hey, I am valuing a brand today, but the brand doesn't exist today. I am going to build that brand 5 years from now.
No. Brand, it's not about brand you build. What typical, I mean, thoughts are, brand is a promise, and what does any brand do it? Either it, as other person saying, either it helps in volume or it helps in margins. Principally, it has to stem out to a particular quantifiable number. Correct. So when I am looking at my projections in future, here is it. Why do we have this inorganic equation? Purely from this perspective, it takes so many years, 5 years. It's our own estimate. What is it that I need to spend? What is the savings that I'm going to have it if I have to take some other's brand? That difference is what something I'm willing to pay. So now what happens?
Okay, great point. So sorry. So that is exactly where the relief from royalty method concept comes in, sir. So then what we are saying is that I'm going to acquire your brand. So what is going to be my projected revenue using your brand from tomorrow? Correct? And against that, how much royalty I would have to pay?
Yeah. So why the reason I'm a little of discomfort, and I'm not an expert here, is a royalty relief rate is a function of the product and the sector. So for example, if I were to take a high margin sector, very high margin sector, the royalty rates are much different as compared to a low margin sector. So when we narrowed it down saying it's 5% or 4%, it's a function of actually many other parameters that you put a number. So
100%. Agree. Yes.
What in other words, what I'm stating here is ki, if we narrow it out, because I was not, I'm sure I've not done that. I've done something else on savings, largely my evaluation. Cost method, the foundation of the cost method is higher I spend, higher is my brand value.
Right.
It is someone use the word counterintuitive. It may not be true because you lose money just by throwing money out. So you go and tie up with brand capital of Times of India Group and put front paper advertisement because brand has to live to a promise, and it also falls flat immediately. So you cannot just create value. The second thing is market approach. When you said the concern I have is, as you only stated, that is almost next to impossible to figure out the comparables.
Right.
So therefore it struggles. The third aspect is the relief from royalty, or primarily what you're referring to is on the savings or the opportunity loss or the opportunity cost that you're involved in. And that is where when we narrow down ability to, because someone who is trying to buy or sell is able to narrow down the benefits of the product volumes or the price margin. Because if someone is eyeing it, he better know the business what they're entering into.
Right.
Use that savings as the method in building over a period of time. And typically beyond a particular point of time, you don't take terminal life. Because after a point of time, there's no reason for you to, because I don't have the advantage of other person's brand. After some point of time, I have to spend, you also have to spend the advantage of the brand. So I would rather have a year-on-year differential advantages captured to make it more realistic in brand value. Otherwise, if I take a uniform rate, it will not be reflecting that, or it might be inflating the brand value.
Correct.
I mean, so the product and volume and margin could be one of the parameters or way we can do the brand valuation.
You can, yeah. So I think so one method that we did not cover in extensive detail today was with and without method, which is where the price and the volume premium comes in. So we are saying that, hey, let us compare. So I am a branded company and I'm comparing against a company which is not a known brand. So how much amount of price or volume that they'll be able to generate? So revenue is a function of price and volume, right? So you look at what's the revenue that they will get, compared that with the revenue that I am getting. So I get the differential, which is with the brand and without the brand, effectively incorporating the price premium or the volume premium or both, and then calculate a present value of that. So we can do it the same way. So yes, we can do that. And plus, when you said that in some companies in high margin businesses, the royalty rates would not be 4 to 6%. I already gave an example. Agreed that for service businesses, it can be as high as 20%. Look at the big fours or a lot of those service companies which are into franchising model. Their royalty rates can go as high as 20%. The only thing we have to identify is that does that 20% constitute the entire value of the brand, right? So sometimes we say yes, depending on the business model. Sometimes we'll say no. Brand valuation is going to be a function of the or a part of the royalty. That's why we take a carve out from there in terms of brand score index factor.
Correct.
Yeah. Great. I think thank you so much. If there's no other question, I think we'll call it off for now. Thank you so much for a very patient hearing this morning.
Yeah, one second.
Thank you.
I'll request Mr. Subbarao to convey a vote of thanks to our speaker.
Thank you.
Yeah. Good morning, all. It is my privilege to give vote of thanks to Mr. Vikas Goel. Vikas, okay, it is a very delighted all of Bangalore Valley members. Because you have given extensive knowledge, practical knowledge in the brand valuation, where we have done 1 or 2 valuations, but we use like with or without method, where now we came to know that we can use this cost method. Other methods also we can use. How much they spent. But in a lot of private company cases, maybe they have not spent more amount, but in some cases they want to have the brand valuation, for transferring purpose, where we did some food valuation, food products company. It is a very knowledgeable session where you covered, like the purpose of brand valuation and the difference between trademark and the logo, and again amortization method. It is good. I think it is not possible to cover entire valuation the methods in one session. Maybe we are looking more sessions from you please have more sessions with BVA. Thank you very much, and thank you for all participants and who attended this session.
Thank you very much.
We also request Vikas to author a book on intangible valuation, which we will all definitely subscribe and buy.
It's a pain to write a book, ma'am. Trust me, I'm writing the material for CMA Institute right now. Yeah, it is a pain. So yes,
Yeah.
I'll see. Let's see what comes out in future.
Yes.
Good luck to you.
Yes.
Yeah.
Thank you.
Apart from this, I request all BVA members, to register yourself as a member, for 22-23. It is going to be end with discount 31st March 2022. If anybody is missing, please register yourself today or tomorrow.
Okay. Thank you.
Thank you.
For those of you who are trying to understand the names of the book, I think it's easier to just go on Amazon and search for Vikas Goel. You will find the book. So there are 2 books. Ensure that you get the latest version of it. That should help. Okay. Thank you very much. Thank you. Take care.
Thank you, Vikas. Even we will promote BVA members also, Vikas. Thank you very much.
Thank you.
Yeah, thanks for everyone for attending this session, and please renew your membership to reap the benefits of BVA. Thanks all. Good day.
Thank you.
Vaishnavi? తిరుపతి ప్రసాదానికి సూపర్ సరిపోయినా కాదు నా దాంట్లో ఇంకా టెన్ వేస్తాను నాకు